So Jason Furman, I think whose name came up earlier, was President Biden's top economist at the CEA. And he recently published a lengthy op-ed admitting that Bidenomics was a failure. His arguments, or what he argued, was I think a lot of Democrats were kind of in denial of this, but the inflation was principally caused by too much government spending. And I know there were numerous bills and that were rolled through while I was a member, the last couple of Congresses, and not just the global shock of the supply chains, right? So, and yet when I read Mr. Conzo, your written testimony, you don't acknowledge that the government spending led to the inflationary increases at all. So I'd just like to hear your response on that, because I think it's important as we look back on what happened now. You know, what is the case by those that say that that did not happen? I don't want to put words in your mouth, so if you could
Absolutely,
respond.
I'm very familiar with Jason's article. You know, to me, it's an argument from 2022. Jason Furman at that point argued you would need a mild recession to get inflation below 4% and a severe recession to get inflation below 3%. Right now, inflation is about 2.5%. Still a little higher than we'd like it, but with a period of growth that was above trend and unemployment below 4% on average. So I think that argument, which is what the argument is of the piece, there's a lot of different arguments about how much the ARP, American Rescue Plan, may have contributed. Prices rose about 21% under President Biden's 4 years. Normally, they would have risen about 8%. I've seen some arguments that maybe about 2% of that could have been attributed to fiscal stimulus. So, you know, would 19% instead of 21% prices really have changed the needle for everyday families? Probably not. And the income security that came, particularly through the child tax credit and many other things, helped stabilize balance sheets that I believe gave us the best recovery following the invasion. You know, you can look at blue chip forecasts, as was brought up before, this private, nonpartisan. You know, even after the American Rescue Plan passed, you know, the highest estimate in blue chip for inflation in 2022 was 3.2%. The actual number was 8%. I think the shocks of the reopening, the shocks of huge changes in demand, and, you know, as a reminder, the unprovoked invasion of Ukraine by Russia really threw commodity markets into turmoil, which, you know, in the long run, those relative prices don't matter, but in the short term, you know, the price of goods skyrocket, but the price of services do not fall. And that increases overall inflation, and services come back online into a higher price level. So, you know, we can argue at the margins how much of a difference it made, but the idea that it was the primary driver of an inflation that was global and was seen by other peer countries, I just don't think the evidence is there.
So, Dr. Michelle, wasn't inflation the result of not just supply-side shocks related to the pandemic, but just too much government spending? I mean,
yes, it definitely was a cause, one of the causes for sure, and that it did occur globally, by the way. We're not the only country that did a lot of government spending, so we're not unique in that regard either.
Well, Mr. Cohn, let me just kind of switch topics real quick. Recent economic data indicates long-term interest rates have disconnected from the Fed's expectations. With 10-year rates now about 40 basis points higher than what the Fed expected, I think. Do you think that was predictable, or do you feel like everything that's happened, you know, we've had the chairman before the committee numerous times, the full committee. Where do you think we are right now?
I think there have been a couple of different contributors to the rise in long-term rates. One is that because the economy was so strong in the fourth quarter and coming into the first quarter, and financial markets were so ebullient, people took out some easing that they had built into the Fed policy. So they thought the economy was going to be weaker, Fed policy was restrictive, Fed was going to have to cut interest rates by more. Now they put a little more back in there, but the Fed itself and the market saw less need for easing. So it wasn't a question the Fed would need to raise rates, but it would be easing less. Secondly, there's a little bit of extra inflation in there, partly because of the concerns about the tariffs and what that would do to the price level, near-term inflation. And third, a lot of it is the so-called term premium, the stuff we can't attribute to expected policy or inflation. It's uncertainty about what's coming next. The fact that if you're holding a long-term security, you're taking risks because the price of those securities go up and down. You need to be compensated for risk, and you have concerns about the risk. Some of it could be the fiscal trajectory that we've been talking about, the unsustainable fiscal trajectory, and few hints that it'll change anytime soon. So I think there are a bunch of different reasons for that basis point increase in the 10-year rate.
Thank you. Mr. Chairman, before I yield back, can I ask unanimous consent to insert Jason Furman's op-ed titled "The Post-Neoliberal Delusion and the Tragedy of Bidenomics" into the record?